Well, it's been a week since Donald Trump won a decisive victory in the U.S. presidential election, and he's bringing an ambitious agenda to his second term in office. So what will the market implications be? Jeff Evans, Vice President, Director, and Lead of Empirical Research and PM Support at TD Asset Management, is here to talk about it. Jeff, thanks very much for joining us.
Thank you for having me on. It's always a pleasure to be here.
So as Trump mentioned, he's promising a very aggressive tariff agenda, including a 10% tariff on all imports. What's the potential impact of all of that?
Certainly. So tariffs were certainly one of the big policy changes in the first Trump administration, bringing in tariffs of up to 25% on a wide range of imports from China. He's continued that theme, first of all, ratcheting it up, potentially talking as much as 60% tariffs on Chinese goods in this round. And then the more interesting development has been this baseline universal 10% tariffs on all imports into the United States. A couple of things I'd point out. Trump is no stranger to negotiations. He's done this many times before. I think the first rule in negotiating is you start high and work down. I wouldn't be surprised if you see a little bit of this watered down. It's certainly a lot of talk for the campaign trail. I would assume we probably end up lower than that. But even if we don't, even if they manage to push through with a full Republican sweep, if they end up in that position, if you get that full 60% tariff on Chinese imports and 10% on the universal tariff, there's a lot of things that consumers can do to work around those tariffs. If you look back at what happened the first time round, any of the goods that saw that full 25% tariff saw a significant decline in imports into the United States. Consumers voted with their wallets, changed their consumption patterns, and bought other goods and services. I think you're going to see exactly the same thing this time around. The easiest way to offset the inflationary impact of tariffs is to just not buy those goods and rotate to something else. Now that's easier said than done. We import a lot of goods from China that are hard to replace in the short term, so we won't be able to trade away from everything. But if you look at some of the categories that are on the list of potential for higher tariffs, it's things he didn't go after the first time. It'll be clothing, toys, sports goods. Those are sort of the high value categories that didn't see tariffs on the first round. And the simplest thing, and as sad as this is for the kids, maybe instead of 10 gifts on your birthday, maybe you just end up with 5. And unfortunately, that's probably the easiest way around a lot of these inflationary pressures from tariffs. You're probably going to see a movement of that purchasing power to domestic services, maybe go for dinner more, maybe go to the spa every now and then. There's other things that you can shift that consumption to offset the tariff risk. And then the last thing to keep in mind, even if you get the full 60, even if consumers don't change their spending patterns, this is only a one-time thing. If they put the tariffs in 2025, by 2026, it rolls out of the inflation calculation. We go back to 2% pretty quickly. So the central banks and the large businesses are probably going to look through most of this. And I would imagine the actual impact is probably a lot lower than people are initially expecting. Okay, so
that's a great overview on the tariffs. He's also promising swift immigration reform. What are the implications there, especially for corporate growth?
Absolutely. So I think that's, again, something else that we'll see what happens with the House. It's looking pretty close that it could be a Republican sweep. If that happens, some of the estimates we've seen would be suggesting immigration could drop by 50%. Was running about 1.5 million a year in recent years. That could go down to about 750. So it's still immigration. You're still going to be growing the U.S. population. But you're going to have potentially certain pockets of the population that are growing slower. And then there's also this risk of potential deportations from the U.S. on some of the undocumented or immigrants that have not gone through the formal immigration process. And that's where potentially there's concerns on wage pressures. Generally speaking, though, this is not going to be what you saw in COVID with widespread wage pressures across the U.S. economy. Most of the industries that are affected would be things like construction, so housing construction, leisure and hospitality, and agriculture. So you're going to see pockets of potential risk. I think the key thing to keep in mind is, do we see an increase in the job openings the way we saw in COVID? That's what drew or caused the wage price spike. So I think at the moment that's coming down, wage pressures are coming down. We'll see how things pan out, but at least for the time being, the labor market data is fairly healthy.
Okay, so let's talk about industrial policies. What sort of impact do you expect from his industrial policies? Because it looks like Elon Musk may have a voice on policy. How do you see that playing out?
For sure. I think that's been one of the most interesting surprises over the last couple of weeks with Musk, operating in the background, funding some of the campaign, working a lot with X to get the word out on Twitter, or X now. And then more recently, this idea that he may take on a more prominent role in government, whether it's a formal position or not, seems to be up in the air. But the idea of focusing on government efficiency, really trying to either eliminate spending wherever they can, or just find ways of removing red tape, making it easier to get things done, and ultimately grow the economy. That's potentially a swing, because going into the election, the big concern with Trump and the Republicans was that you'd run a much larger budget deficit in the US compared to what the Democrats and Harris would potentially have run. That's still expected to be the case, I think, for the next year or two. Republicans, with the tax cuts, both the personal and corporate tax cuts, that could lead to a slightly wider deficit in 26, maybe 27. But as you go out longer term, if you can get some of these efficiency gains, if you can grow the economy a little bit faster, there's a possibility that these expectations are, they were based on the assumption that Musk wouldn't be there. Maybe we end up with a smaller deficit than people were expecting.
And he's going to have to juggle his job as CEO of Tesla and other things as well. So
exactly.
Yeah. All right. Corporate taxes were also a key theme in the campaign. What implications will that have on earnings?
Sure. So a few things. He's been suggesting trying to bring the corporate tax rate in the U.S. down to 15%. Again, we'll see whether that happens or not. There's a lot of jockeying back and forth, and it's a lot easier to do if you have a clear majority in the House. It looks like this is going to be a little more razor thin. So it has been something that's been contentious in the past. At this point, we'll just have to wait and see the full impact. But if that does happen, it would, at the margin, be a positive for small cap stocks and companies with a significant domestic focus. That's where that full benefit of U.S. tax cuts will be visible. Whereas for the larger multinationals, the big tech stocks, for example, that operate in lots of different jurisdictions, they'll benefit at the margin from U.S. tax reductions, but they're still paying much higher tax elsewhere. So I think that'll be the interesting disconnect. It's probably more beneficial for domestic companies, small and mid-cap stocks, and then we'll see how it shakes out for the larger names. On balance, what we've been seeing is probably 5 to 7% benefit for the index in general. So obviously some of that we're now starting to see priced in a little bit post-election with some of the move. But ultimately still probably a little ways to go. As far as sectors are concerned, again, small caps, the biggest beneficiaries, real estate and utilities would tend to be some of the least impacted. Real estate because in a REIT structure you don't pay tax, and utilities because they tend to earn regulated returns after tax. So you'll see some sector differences as well, but I think that's broadly the potential impact from tax reductions.
Okay, you talked about wages and inflation. His policies are raising some concerns about possibly stoking inflation. How does that impact the Fed and its path forward on interest rates?
Absolutely, and I think that was, it's interesting. He appointed Powell back in his first administration, and then very shortly thereafter started to get into a bit of a feud on policy. And really, it was Powell had to raise interest rates to try to choke off inflation as it started coming back. Trump didn't obviously favor that, and given the potential impact for economic growth. This time's a little different because we're now on the right side of that. Powell's cutting interest rates, maybe not as fast as Trump would want, but they're directionally moving towards lower rates over time. And Powell only has about a year and a half left in his term as Fed chair. That expires in, I believe it's June of 2026. Some of the commentary that you've seen out of Trump over the last couple of weeks has been that he'd probably largely leave Powell alone to end his term and ultimately make a change in Fed policy or Fed chair at some point later in the administration. So it seems like he is maybe backtracking a little bit on this idea of interfering with the Fed and particularly the Fed chair. That said, he also has made it clear that he should have a voice on interest rate policy. That continues to come up in the campaign trail. And I think that's probably the biggest risk. And in my view, probably more so than tariffs and probably more so than wages, where things could really become unglued is if you start to interfere with Fed independence. That's where you can see a much larger escalation in term premium on U.S. debt. Maybe you see the 10-year push through 5. And that's where you start to get sort of a negative reinforcing loop on equities in the broader economy. So I would watch that carefully. He has been a little bit more careful in the last few weeks on what he's saying on Fed policy. But at the end of the day, we just don't know where it'll pan out. And I think watching whether he will be mostly hands-off with the Fed will be important for markets over the next few years.